TheoTrade. This is Don Kaufman. It's February 24th, 2023. There's just about 12 minutes left inside of your trading week. Doing the weekend update here on a Friday afternoon. SPOOs are off some 53 handles. Look, this week overall, it's been ugly, which of course has got us asking the question, are the Bears back in town? Let's get to that and much more here on this weekend's update. All right, first and foremost, look, some sell-side activity being generated today. All right, it's nothing, though, in comparison to the price action that we saw basically on Tuesday. Now, remember, this was a shortened holiday trading week. We came out swinging on Tuesday. S&Ps were down about 80 handles. What did we do on Wednesday and Thursday? Well, the answer to that is absolutely nothing, followed by some more sell-side activity here on this Friday. But here's actually one of the very key points that I want to make. And the first question here under the bullets, bulls folding under inflationary reality. I have to actually state in this particular case, look, today, this morning, the PCE indicator came out. Now, for those of you that have absolutely no idea what the PCE indicator happens to be, that is fine. It's an inflationary indicator, but it's also an indicator that is, if you will, the Fed's indicator of choice, right? That's not my saying. That is Jerome Powell himself saying that is their indicator of choice. That indicator of choice, it came out and it was hot. It was really hot. It was so hot that I got to tell you, look at the S&Ps right now, only being down maybe 1%. NASDAQ is off by 2%. I got to tell you, this leaves some risk on the table. You got out of this one unscathed. And I'm dead serious when I say that. Hey, maybe the marketplace sold off because it felt that the PCE indicator was going to come out hot, prior to. Either way you want to look at this, it is not pretty. It's just not pretty. And, I'm just going to jump right into it. The Bears are back in town. They are back in town. There's no question about it. Take a look at the spiders and let's actually go. Here's the spiders. And, I've been on several of these videos here on the weekend update. And, throughout the course of the week, I've been asking, what's different about this rally from this rally from this rally? And I keep saying, well, the rally that we saw at the, the beginning of 2023, this rally was actually smaller than the previous rallies, of course, of 2022. And I'm gonna call it here, people. It's over. Okay. Doesn't mean we can't bid back up over here, but there's no question at this point. Yeah, you're still in some extreme volatility, which we kind of knew. Like, are the Bears back in town? The Bears never left town. All right. You're going to get wild bids back to the marketplace. When you start looking at this, though, on a year-to-date basis, okay, what do you got over here? Okay. Well, we were up almost 9%. Now are we? Yeah, we're not even up, but not even 4%. So yada, yada, yada. Okay. It's all over but the crying. And now at this point, we're going to face some very key levels. Let's jump right into the key levels. So with that, we're going to jump back over to the S&P futures. Why do we look at the S&P futures? Because they drive order flow, people, to the entire marketplace. We are right back in it at this point. So for those of you that have not been around TheoTrade for a while, we have some very key levels, one of which we call gravity points. Here we have 39.31 inside of the ES. And I'll tell you right now, that 39.31, we are close, people. We are right up against that 39.31. I mean, obviously, we're trading 39.65, so you're about 30 handles off of it. I have to tell you, I'm a little surprised in today's trading session that we didn't actually get down and tag it. And again, I'm left wanting more out of this volatility. So 39.31, I'm already going to look forward to next week. Okay, I think has to make an appearance. So at this point in time, again, we came all the way back up to the 42.11. We faded a little bit. We found another gravity point in here somewhere around 41.06. We came off hard and fast from the 41.06, and here we are once again facing again the 39.31. Now, critical level. And when I say I want to be very forward looking, look, there's a lot of times we can, spend the entire, 20 minutes here in a weekend update, looking at the past. Okay, it's not going to do you any good. Look, you're in the midst of volatility again, and you should know that right off the bat. When you're in the midst of volatility, all you can really latch onto are levels, right? So here's an absolutely key kind of inflection point. That's why we call it a gravity point, but it's a key point inside of the market. Again, the 39.31. And the reason I think it's so critical is if we do come down to it, okay, it doesn't necessarily mean, well, we could bounce. Yeah, we can moderate around it, but losing the 39.31 at this point could actually be rather dire for the marketplace. And that is where you might see volatility start to explode. Again, we'll do a little bit of a check on volatility here in just a moment. All right, so we talked a little bit about how, well, bulls are going to fold under inflationary, the inflationary reality. We talked a little bit about how 39.31 is coming back into play. And, look, it's how many times we've talked about 39.31 over, well, I've actually got to zoom the chart out here for just a moment because this is a level that we identified. Again, you got to come all the way back into the time frame of May of 2022. Right? We're almost a year into 39.31. And again, it's very highly likely that we're actually going to touch down into it. And we're going to get a good feel of what volatility is going to look like thereafter. And of course, that's probably going to unfold this next week trade. So nevertheless, we talked a little bit about levels, inflationary, pressures. The next really big thing on the radar screen is some of the sector rotations that we're seeing in here. It is unusual. And by the way, if it sounds like I'm like a question mark, it kind of is. Because I'm going to tell you, throughout the course of today's trade, most of today saw a horrendous advanced decline line. I mean, most of today's trading session, we had anywhere from like 95 to even 99 stocks trading to the downside. Well, here we are, it's 5 minutes to go to the cash close. There's 22 products that are actually higher. What are those 22 products? And lo and behold, okay, you have one odd sector out, and that happens to be none other than financials. Now, for those of you that have actually tuned in some of the videos that we've done, I've talked about financials till I am blue in the face, because I'm going to tell you right now, the key to a broader sell-off in the S&P 500, unequivocally, the financials. And what I wanted to bring into scope with the financials right now, the financials, okay, right now, right here, they absolutely started to break last week. This week, they got slaughtered early on in the week. Okay, coming into the cash close, though, they're actually reaching back for the edge of the expected move. It's a really kind of precarious move, okay, that is countering, and it's actually lifting, if you will, the S&Ps. Again, I don't like to see price action like this because, well, first of all, it can be a little confusing to people, but secondly, it doesn't bode well for some of the trade because if you look forward to next week, if there's going to be sell side activity, you got to realize the S&Ps are off by 1%, the Nasdaq's down by 2%, and you don't even have participation of the financials to the downside. Okay, it leaves a tremendous amount of risk on the table. So the big question is, why are the financials rallying today? I'd have to believe that, I mean, the financials, they love some of the sell side activity that's transpiring inside of the bond market. If you go take a look at the TNX, look at this, okay? Interest rates. So if you're kind of curious why the financials might be bid today, why? Well, who's buying the financials? Well, this is the 10-year interest rate, which has absolutely skyrocketed. We're facing again close to a 4%. And I say facing again, look how far we've actually come, people. So if you're a little bit nervous that rates are starting to pick up again, they absolutely unequivocally are. And I have to tell you, I'm a little surprised by the price action here in rates. Rates have taken off to the upside. At what point, though, okay, is the marketplace just going to be dismissive and say, you know what, the financials are going to go down with the rest of the marketplace? What I urge you to understand is if the S&Ps really start to sell off, there's not going to be financials that are going to be the savior. The S&Ps really start to sell off, I think we're actually going to see rotations into the bonds. That means buyers of bonds. Why would they buy bonds? Buy bonds for a little bit of downside protection. You start to buy bonds, and ultimately, what do you have? Financials are going to get absolutely smoked. We have a lot of risk on the table right now. So again, as I said to you, the PCE indicator comes out and kind of left some sell side activity, I believe, on the table. The financials are the strongest suitor, okay, in terms of a sector today by far and away. after getting hammered early on in the week, they actually turn around and save the marketplace. These S&Ps could have easily been down 70, 80, 100 handles, okay, based on that PCE indicator. And again, all saved by the financials. You got to watch this, okay, sector like a hawk this next week of trade, because if we're coming off big, you better believe the financials, they're not just going to participate. They have to participate to the downside for the S&Ps to really, okay, start to break into some hostile territory, and that is, well, below 39.31. All right, moving on. Okay, moving on. Now we're going to look at some indications of risk in the marketplace. One being, of course, none other than the US dollar. We actually saw this kind of trend throughout the course of last year. And I say last year, in 2022, okay, we just bought dollar basically with both hands. Okay, we're starting to see a very similar trend right now. And I say, if a rally in the dollar is bad, this is going to hurt. Now, there's no telling, like, is the rally in the dollar going to persist? You can talk about this till you're blue in the face. You're like, oh, look at the dollar, it's going up. It is absolutely trend up in the US dollar. Okay, there's no question that the US dollar at this point points to there's just a ton of risk inside of the S&Ps, and unquestionably buying the US dollar is being used as protection. Now, we're not clear whether that's going to be sustained, but at this point, take it very seriously, because the move inside of the dollar to the upside, here we come to the cash close. It's over. The move in the dollar to the upside, okay, in my opinion, has been rather fierce, okay, versus the sell side activity expressly inside of the S&Ps. So lo and behold, I think we have, again, if you're looking at this as like risk on, risk off, you got to be a little bit nervous at this point, because the dollar right here, right now, that is closing highs for the year inside of the US dollar. But at the exact same time, let's go over to the spiders. Is this the closing low for the spiders? No, not even close. I mean, the spiders would have to get under, the 380 handle for this to be closing lows. And it doesn't have to be a perfect one for one. But the point that I'm, trying to make with this one, if you looked at the VIX and VIX was just soaring day in and day out, you would absolutely be concerned. Well, I look at the dollar as a little bit of like the new VIX, and I am concerned at this point, because there's so much that's gone into the dollar lately that a whole lot of risk, obviously, again, on the table inside of the S&Ps. So as I say, if the rally in the dollar is bad, then this marketplace is going to hurt a little bit. So the next aspect I want to look at here is a little bit of a read on volatility. And of course, everybody thinks that I'm going over to the VIX, but I'm really not. One of the first things I do want to mention about VIX is VIX, ironically, kind of peaked out earlier this week. All right, so here we have S&Ps down over 1% today, NASDAQ down almost 2%, and the VIX actually contracted. So yeah, VIX is up, but it contracted, right? It contracted from where it was earlier in the week. Again, I just, as I always say this, VIX is my predecessor's volatility indicator. What I much prefer is to look at volatility futures or something like VVIX. We'll come down to VVIX in just a moment. But if you take a look at the volatility futures, and I was mentioning this on the Wednesday night video, and I want to reiterate it again today. There's some weird price action in here because we're really close to a what we term contango and backwardation. Okay, and what backwardation would indicate is that there's more risk in the present, like right now, we're on fire, and that things are going to mellow out in the future. We're actually really kind of close to that, much closer than I would have thought. So for the most part, you got like 1 week. This is it. This is the big sell side activity that's generated this week. And all of a sudden, where are we right now? Okay, we're very close to volatility futures being completely flattened out. If you look at the 54-day versus the 82-day volatility futures, all right, you are 2290, okay, by, let's call it 2310. There's like 20 cents differential, okay, between the 54-day and the 82-day. And again, it looks alarmingly tight to me. It's like the marketplace really is starting to price in some very considerable risk. And it's yeah, the 26-day is at 2220. But look, normally, especially in markets, even that have sold off in the last couple of months, we've seen like a point and a half between 26-day and like 54-day. Like front and back months got a point and a half. We're nowhere near that. I mean, we're tightened up here at about, we're at 65, 70 cents. The back month over here is at 20 cents. People, volatility read, it's not positive. It's not positive for the S&Ps at all. If you want the read on VVIX, VVIX is the volatility index. It peaked and actually fell. Okay, fell considerably today. So this is not portraying, if you will, a considerable amount of risk. But the volatility futures absolutely are. So it's a little bit of a catch-22 in terms of a volatility read. Again, I reiterate, 39.31 is going to be the pivotal level. Breaking below that early on in this next week of trade, okay, could actually be a considerable like onslaught, if you will, of volatility. But again, a lot of that is going to be very largely based on what the financials are going to do. And that is when you start talking about financials, look immediately at the bond product. If we start seeing sell side activity in the S&Ps, are people going to rush and start to buy bonds, right? And actually invert the yield curve considerably, even more so than it already is. So it's a lot to actually think about when we're talking about bears back in town. Yeah, unequivocally, the sell side is here. It's back. You've basically just taken the gains of the year and thrown them out the window inside of a holiday 4-day week. Volume hasn't been like wild inside of the S&Ps, but it's rocking out there. Like again, you can feel though that volatility kind of creeping back in. All right, let's continue on. Get your trade on, kind of a weekly segment here, and we talk a little bit about this week's profits and losses. All right, what did I do this week? Covered tons of short calls. I mean, the sell side activity was like spectacular for short calls. When I talk about short calls, okay, early on in the week, buy to close, buy to close, buy to close, buy to close, buy to close. I was buying everything to close. And if you look at my my order history here, you're like, what? He only had 14 fills? Yeah, only 14 fills here on Thinkorswim. I'm now trading much more inside of Tasty. So a lot more fills in here. And again, a lot of this is buy to close, buy to close. You can see all the different trades for buy to close. BTC, by the way, is buy to close, right? And then after I bought positions to close, again, it was a very nice week, very profitable week. But as I was actually, with my buy to close, I then spun back around and opened up a number of new positions inside of the TheoTheo portfolio, new Catapult positions, and of course, new positions in the TheoTheo small portfolio. That just amounted to, well, I sold premium, and I sold premium, okay, Tuesday, Wednesday of this week when the VIX actually took off to the upside. A nice little opportunity to sell some premium. We took advantage of it, opened up some beautiful new premium sales. Again, S&P options on futures, which hold very minimal margin. I also traded pretty extensively like the micros. So the new S&P, of course, micros. It's been a spectacular product if you haven't looked at that. Okay, the CME has actually done a phenomenal job with the S&P micros in here. So we opened up a bunch new premium sales. Our Catapult portfolio on fire right now. For those of you that are not involved in the Catapult portfolio, you should get involved in the Catapult portfolio. When I say it's on fire, like our QQQ position over here, take a look at some of the returns. It's about 446%. And what we do in the Catapult portfolio, the Starbucks trade is up about 78%. What we do in the Catapult portfolio is we finance trades. And I'll give you an example. We finance trades like in Goldman Sachs, Intel, QQQ, Starbucks, okay, Tesla. We are financing these equity trades, Apple, by selling options, okay, in the S&P options on futures. So we're not even paying for the trade on Apple. We're not really paying for the trade in the Qs. We're not paying for the trade in Starbucks. And yet, okay, we're trying to knock the cover off the ball, and that's exactly what we are doing inside of Catapult. Now, those Catapult trades are on fire, but it ain't over, people. It ain't over. Okay. The other thing I did today is I actually opened up a new spread inside, an in-out spread inside of JP Morgan. Okay. I'm a believer at this point that the financials, yeah, maybe they bid up a little bit more. Took a short position inside of JP Morgan. Okay. Why? Okay. How? Well, I used an in-out spread. So for the most part, using an in-out spread, one strike in the money, one strike out of the money. And by the way, our volume obviously stands out like a sore thumb on here. It's about 2,300 contracts have traded in there. And I actually used this in-out spread to take advantage of, again, what I think could be a decent pullback inside of the financials if the marketplace starts to rush buy bond products out there. And short JP Morgan's where I want to be. That's a little bit about get your trade on. Look, this week really came down to premium selling. I know that's not an exciting concept to anybody, but here's the bottom line. Week in, week out, we talk about how we're covering premium sales, how our catapults are on fire. Okay, it just comes down to, hey, it's boring, but it's incredibly consistent. Last but not least, what we cover each and every week here on the Weekend Update, talking a little bit about the SPX, the mother of all products. And the SPX is going to end, of course, this week. And effectively, the SPX is closed. The options are still technically a trading out there. But the SPX unequivocally has closed outside the expected move. And we talked about this, right? We literally talked about this last Friday. The expected move for this week was plus or minus $73. Okay. Did we crack outside of it? Yeah, of course we did. How much did we actually move? You can see we actually closed last week right around 40.80. Where did we close this week? 39.70. It's basically a 110-point move, and we were expecting a $73 move. Okay, so again, put on your big boy pants. You just had a 110-point move inside of the SPX. But the big question is this. What are we actually facing next week? All right, and the reason I'm bringing this up right now is because before actually coming on here and shooting this video, I must have looked at this, I don't know, 8, 10 different times, and I'm just shaking my head. People, I cannot stress to you enough, all right, my, if you will, dismay, disappointment, disillusion, if you will, with the SPX expected move. We just saw 110-point move. Everybody saw it. Now, I know not a huge amount of data is coming out next week. Okay. There's still some Fed speak left, though. The expected move for this next week of trade is plus or minus. It's going to come in somewhere around $76. Now, this is not set yet. It's not set because the options still have about 4.5 minutes to trade. We're going to have a $76 expected move. You go, well, whatever, man. That's more than the previous week. Yeah. This last week, though, was a 4-day trading week. You mean to tell me we just had a 110-point move, right? And market sold off considerably. And now we have a 5-day week coming and only a $76 move. And the answer is yes. And that's why I said I'm a little disillusioned with that. Okay. Now, I'm not one that's going to go out on a limb and start screaming, the SPX is wrong. But I am going to tell you the 0-day expiration options, they've made this a marketplace on a week-to-week basis. I would not sell anything for a week. I wouldn't sell anything for 3 days. If you are selling short duration options, people, you're going to get annihilated. Think about it. We just moved, okay, $110, but the options only priced in a $73 move. Okay. Now we have a 5-day week ahead of us. We're pricing in a $76 move. Would you sell that? Okay. We had 1 day this week, 1 day. That was what we call Tuesday. Yeah, that was over an $80 move, right? How many times do you have to see a vicious move occur before you start to realize you're like, yeah, he makes a pretty valid point over there. Again, very disillusioned with only a $76 expected move in here. All right. That is pretty much it for this weekend's update. Again, some very specific levels over here. Watch financials throughout the course of the next week. And of course, the bonds. If they start buying bonds, it'll be a nail in the coffin for the financials. S&Ps will really start to get wild. But also anticipate, okay, the print of 39.31, which is really going to keep us on edge throughout the course of this next week of trade. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.